Hello and welcome to the video presentation of accounting based on the SYSCOHADA framework. I'm your host, my name is John Paul Ongolo, and lay back, get relaxed, and I will get you through this video presentation. It will deal mostly on depreciation, impairment, and the recognition of fixed assets. If you need any other information, further information, or you have any questions, you can write under the contact section or the comment section in the website, or you can contact us at these different pages. You have the contact number here and the email. So as a reminder, these are the different classes of accounts in the SYSCOHADA accounting framework. Our presentation will stress on class 2 fixed assets by looking at the methods of depreciation, impairment, and the recognition of fixed assets. This slide shows the different sub-accounts of class 2 fixed assets. However, we are going to look at depreciation, impairment, and the recognition of fixed assets as a whole. However, stay tuned for other video presentations that will stress on the different sub-accounts and stress on their accounting in much more detail. So this is the table of contents of our presentation. As explained earlier, it will stress on three main areas. First, depreciation of fixed assets. Secondly, impairment of fixed assets. And thirdly, how to derecognize fixed assets. Remember that for any accounting item, you have the initial recognition, subsequent recognition, and derecognition. Depreciation and impairment fall under subsequent recognition, and derecognition obviously falls under derecognition. The presentation, which talks about initial recognition of fixed assets, is available, and we hope that you have gone through that presentation first before going through this presentation of subsequent recognition and the recognition. Okay, so we start with depreciation, and depreciation follows one of the underlying principles of accounting, which is the matching principle, where we try to allocate the cost of the asset over its useful life to try to match it with the use or the revenues that the asset generates. It should not be, under no circumstances, thought that depreciation is a way of representing the drop in fair value of the asset, because there are some assets whose fair value instead increase with time. So with the depreciation principle, we are trying to share across the useful life the depreciable amount of an asset. That depreciable amount is the difference between the initial value of the asset and its residual value. The initial value of an asset, which we saw in the previous presentation, how we could determine the initial cost or the initial value recognized in the financial statement of an asset, and the residual value. This residual value is the estimated amount that the entity will obtain from disposal of the asset, less any costs of disposal. We have to note that this standard is in line with IS 16, International Accounting 16, Property, Plant and Equipment, paragraph 6. So, how then can we depreciate fixed assets? First method is a straight line method, which results in a constant charge over the useful life if the residual assets value does not change. The tax system in Cameroon uses a straight line depreciation for fixed assets. The next method is the diminishing balance method, or in some other cases is also called the reducing balance method, which charges a decreasing charge over the useful life of the asset. This method is more in line with the matching principle because it charges a higher depreciation charge during the first years of use of the asset, when the asset is still new and hence more productive, and charges a lower depreciation charge towards the end of the useful life of the asset, when the asset is a little bit more older and hence less productive. Another method is the units of production method, which is a charge based on the expected use or output of the asset. So an entity will select the method that most closely reflects the expected pattern of consumption of the future economic benefits embodied in the asset. Remember that the aim in accounting is to provide or to prepare true and fair financial statements, so the entity will select the method which will show the best possible presentation on that fixed asset. This is in line with International Accounting Standard 16, Property, Plant and Equipment, paragraph 62. This method will be applied consistently from period to period unless there is a change in the expected pattern of consumption of those future economic benefits. We have to note that depreciation of an asset will begin when it is available for use. That is, when it's in the location and condition necessary for it to be capable of operating in the use that management wants. This means that buildings or assets which are undergoing construction cannot be depreciated unless the construction of the building has been terminated. A depreciation plan can be modified. It's possible, it's permitted by the standards to modify the depreciation charge if it results in a better and or more faithful representation of the depreciation of the assets. We have seen the different depreciation methods that we can use based on the SYSCOHADA accounting standards. However, a depreciation method which is based on revenue that is generated by an activity is not appropriate. The reason being, the revenue generated by an activity that includes the use of an asset generally reflects factors other than the consumption of the economic benefits of the asset. This part of the standard is in line with IS 16, paragraph 62A. Hence, you have to look in the next slide on the factors which we should consider in determining the depreciation rate or the useful life of an asset. So some of the factors we can consider in estimating the depreciation rate or the useful life of an asset are these are some of the factors you can consider, and as such, with these factors in mind, you can then estimate a useful life or a depreciation rate or percentage which should be applied in the depreciation of the asset. Next, we will look at the double entry principles on depreciation. So, at the end of the year, when depreciation has to be recorded on an asset, we are going to debit the relevant account 681 depreciation expense account and credit account 28 accumulated depreciation by the depreciation charge of the year. These accounts, account 681 and account 281, have sub-accounts, and you are going to choose the relevant sub-account which ties with the fixed asset you are trying to depreciate. So usually account 28 is a credit account. However, it does not appear in the liability section in the balance sheet, but appears as a negative amount in the asset section to reduce the cost of the asset to its net book value. However, account 681 is an income statement account and is an expense or will be an expense for the year. Hence, the amount is not carried forward for future accounting periods. But when you revise the depreciation plan, we are going to debit accounts 28 accumulated depreciation to close that account. This is because we have revised the depreciation plan, and hence we are going to put in place a new depreciation plan. The revision of the depreciation plan may occur because the useful life of the asset has been revised, and hence the previous predetermined depreciation plan is outdated in that case. So the first thing to do is to close the accumulated depreciation account, because the accumulated depreciation that has been recorded up till this date is outdated. And we credit account 798 depreciation expense written back, or account 862 depreciation of non-operating fixed asset written back. So it depends whether the fixed asset is used for operating activities or non-operating activities. If the fixed asset is used for operating activities, we are going to credit account 798 depreciation expense written back. But if the fixed asset is used for non-operating events, we are going to credit account 862. So let us have a look at the depreciation double entry once again. First, for normal depreciation, we debit account 681, the income statement account, and credit account 28, the balance sheet account. The account 28 will show accumulated depreciation which has been charged on the fixed asset. But when the depreciation plan is revised, we close the account 28 accumulated depreciation by debiting that account, and we credit either account 798 depreciation expense written back or account 862 depreciation of non-operating fixed asset written back. So that's that with depreciation. We are going to progress by looking at impairment of fixed assets. The next section of our presentation looks at impairment. At the end of each period, an entity must determine whether there is an indication that an asset has faced a loss in value. It means an impairment review is carried out at the end of each period, at the end of the accounting year. If the asset has faced a loss in value, then it must be impaired. Impairment exists when the net book value is higher than the actual value. I think you can see the terms in bold on the presentation. This follows Article 46 of the Uniform Act on Accounting Law and Financial Reporting. The actual value of the asset must be estimated and compared with the net book value. The impairment expense, hence, is deducted from the cost of the asset to obtain the new net book value of the asset. Hence, in other words, it means that the net book value of the asset will be the difference between cost less depreciation and impairment expense. The impairment expense must be applied even if the entity is loss-making or profits are not enough to cover the impairment expense. It's a must that an impairment expense must be applied. The actual value of the assets, which we use to compare with the net book value, is the current cost that the amount of treasury or equivalents, let it be cash, let it be bank, that will be spent if the same asset or equivalent was acquired at this present date. Hence, if an asset was acquired 2 years ago, then the actual value of the asset will be the current price of the asset, which will also be depreciated on a 2-year basis so that we can compare like with like. For us to know, remember that we said we carry out an impairment review when there is an indication that the asset has faced a loss in value. And for us to be able to know or to consider whether an asset has faced a loss in value, we have external and internal factors which we can consider. This is in line with IAS 36, paragraph 12. IAS 36 is the International Accounting Standard 36 Impairment, paragraph 12. So, we are going to start by looking at the external factors or sources of impairment. Based on the SYSCOHADA standard, SYSCOHADA lists 4 examples of sources, external sources, which may bring about an indication that impairment has occurred. So these are the internal sources. On the second point, we are told that significant changes with an adverse effect on the entity have taken place during the period or are expected to take place in the near future. These changes that we are talking about include things like maybe an asset becoming idle, maybe plans to discontinue the operation to which an asset belongs, or maybe even plans to dispose of an asset. So all that means that there are changes which are significant and they are expected or they have taken place during the period and which will cause a drop in the value of the asset. So let us then look at the double entry for impairment. The impairment double entry is as shown when we want to recognize an impairment expense. So first, we debit account 6913 if we are considering impairment on intangible fixed assets, or account 6914 if we are considering impairment on tangible fixed assets, or 6972 if we are considering impairment on financial assets, or account 853 if we are considering impairment of non-operating assets. So we debit the relevant account depending on the asset which faces impairment, and we will credit account 29 impairment by the impairment expense. So as we said, we debit the relevant account, maybe account 6913 if you are talking about intangible fixed assets, account 6914 if you are looking at tangible fixed assets, account 6972 if you are talking about financial assets, and account 853 if we are talking about non-operating assets. So we debit the relevant account and we credit the relevant account 29 impairment by the impairment expense. This is the case when we want to recognize an impairment expense. But account 29 impairment is debited when we have a reversal of an impairment loss. The account is debited when you have a reversal of an impairment loss. It means maybe in a subsequent year we want to revalue an asset that was previously impaired. By so doing, we must first reverse the impairment loss, and if we have any other revaluation amount remaining, then we can recognize the remaining amount in the revaluation. In other words, during a certain period, we cannot have in the same account an asset that has been revalued and an asset that has been impaired, the same asset impaired and revalued. So for the same asset, account 29 impairment and account 106 revaluation cannot exist at the same time. So if an asset which was previously impaired has been revalued, we must first offset the revaluation surplus on the impairment that was recognized in the past. If there is any revaluation surplus remaining, that is when we recognize the revaluation surplus remaining in the revaluation surplus account. And to reverse an impairment loss, we debit account 29 and we credit account 791 if we are looking at operating activities, account 797 if we are looking at financial assets, and account 863 if we are considering non-operating activities which were written back. The last part of our presentation deals with the recognition of fixed assets. The recognition may arise when maybe fixed assets have disappeared, fixed assets have been sold, or maybe fixed assets are destroyed. And in each of these cases, the fixed asset should be removed from the balance sheet and the fixed asset register. Because simply the fixed assets don't exist again, and hence they should not be presented on our financial statements. Also, fixed assets which are not being used again should be depreciated in full. During the disposal of the fixed asset, in case of maybe a sale, the net book value of the fixed asset is assumed to be the cost of the asset in order to determine whether we have made a profit or a loss on disposal. In other words, we compare the net book value of the asset and the proceeds from the sale of the asset. The double entry, the disposal double entry is, first of all, we have to recognize the depreciation which has occurred during the year before the disposal until the date of disposal. Then after having recognized that depreciation, we are going to debit account 281 by the balance in that account to close that account. Remember that account 2A deals with accumulated depreciation. So in other words, we are closing the accumulated depreciation account of the asset, because as the asset does not exist again within the entity, the accumulated depreciation account for the asset, or for that given asset which is disposed of, should be closed. So we debit account 281 and credit the relevant fixed asset class 2 account. So that balance from the accumulated depreciation account 28 is carried forward, or is carried to the credit side of the fixed asset account. In other words, in that fixed asset account, after this double entry has been made, the balance in the fixed asset account is the net book value of the fixed asset at the date of disposal. Remember that we said in the previous slide that we use the net book value of the fixed asset in order to determine the cost of the fixed asset, and hence whether we have made a profit or a loss on disposal of the fixed asset. Then we debit account 81, book values of disposed fixed assets, and credit the relevant fixed asset account to close that account. Normally, this credit entry, which we are going to make on the credit side of the fixed asset account, will be the net book value of the fixed asset account. So in other words, we are going to credit the fixed asset account by the net book value of the fixed asset. That entry will be enough, or should be enough, to close that fixed asset account. If that's not the case in your given situation, then there might be an error in your double entry calculations. So with this double entry, we have closed the fixed asset account, we have closed the accumulated depreciation account, and we have carried that balance into account 81, book values of disposed fixed asset. Remember that account 8 deals with non-operating or maybe extraordinary activities or non-operating activities, and the disposal of a fixed asset is a non-operating activity because an entity is not into business to be selling its fixed assets. To recognize the sale or the amount of money received, we will debit the relevant treasury account in case you have received maybe cash or a check payment, or we debit account 485 if we sold or we disposed the fixed asset on credit. So we will debit the relevant treasury class 5 account when we have received treasury, maybe cash, maybe a check on the disposal. But if we sold on credit, we are going to debit account 485. In the case where the disposal involves a part exchange, in other words, we give out a fixed asset, an old fixed asset, to receive a new one, an exchange of fixed asset. In that case, we are going to debit the relevant fixed asset account, the fixed asset that we have received and which we are going to value at its fair value or at its market value. So the new fixed asset that we are receiving due to this exchange will be valued at its book value, at its market value. So these are the relevant debit entries that we can make depending on the situation at hand. And then we credit account 82, which is income from the sale of fixed assets. We credit account 82, income from the sale of fixed assets. Account 82 is relevant to note is debited by commissions or other disposal expenses and credited by the relevant third-party account or treasury account. It means if we pay the commission in order to dispose of the fixed asset, we are going to debit the account 82 instead of debiting the commission expense account, the 63 account. We are going to debit account 82 and credit the relevant third party if the commissions were paid on credit, or credit the treasury account. So we have come to the end of this video presentation, and we talked about depreciation, impairment, and the recognition of fixed assets. These were the subsequent measurements of a fixed asset when we looked at depreciation and impairment and their double entries, and the recognition, as we said, which is due maybe to the disposal, to the sale of a fixed asset, maybe due to the fact that the fixed asset got damaged or destroyed, or maybe that we don't use or we don't have a use for that fixed asset again. Thank you very much for followed this presentation, and we hope to see you soon on the upcoming presentations.